Welcome students. Today we will start with NCERT Class 12 Economics, Chapter 8, Balance of Payments. So let's start. Definition of Balance of Payments. Balance of Payments is accounting statement that provides a systematic record of all the economic transactions between the residents of a country and the rest of the world in a given period of time. Next, classification of economic transaction in balance of payment. Economic transaction in balance of payment are broadly categorized as under export and imports of goods or visible items of trade, invisible items, unilateral transfers, and capital transfers. So point number 1 is export and imports of goods. This includes all types of physical goods are exported and imported. These are called visible items as they are made up of some matter or materials and can be seen, touched, and measured. The movement of such items is open and can be verified by the customs officials. Point number 2 is invisible items. An invisible item of trade refers to all types of service like shipping, banking, insurance, etc., which are given and received. These are called invisible items as they cannot be seen, felt, touched, or measured. Point number 3 is unilateral transfers. Some economic flows between nations also take place without any payment, which are called unilateral payments or transfer payments. Such transfers can either be private or government. Private transfers would include sending gifts abroad, scholarship, etc. Government transfers would include grants and aid. Point number 4 is capital transfer. Capital transfers relate to capital receipts through borrowing or sale of assets and capital payment through capital repayments or purchase of assets. Next, structure or components of balance of payment. Balance of payment account can be broadly classified into the following two accounts: current account and capital account. Current account is that account of balance of payment which records imports and exports of goods and service and unilateral transfers. It thus records the following three items: visible items of trade, invisible items, and unilateral transfers. Next, items of current account. Exports and imports of visible items or goods, invisible items or non-material goods or service, and unilateral transfers. So point number 1 is export and imports of visible items or goods. A major part of transaction in foreign trade is in the form of export and imports of goods, that is visible items. Payment for imports of goods is written on the negative side, debit items, and receipt from export is shown on the positive side, it is the credit items. Balance of these visible exports and imports is known as balance of trade or trade balance. Point number 2 is invisible items or non-material goods or service. It includes a large variety of non-factor service known as invisible items sold and purchased by the residents of a country to and from the rest of the world. Payments are either received or made to the other countries for use of this service. Service like shipping, banking, and insurance, payments for this service are recorded on the negative side and received on the positive side. Point number 3, unilateral transfers. Unilateral transfers include gifts, donation, personal, remittance, and other one-way transaction. This refers to those receipts and payments which take place without any receipts service in return. Receipts of unilateral transfers from rest of the world is shown on the credit side and unilateral transfers to rest of the world on the debit side. Next, capital account. Capital account is that account of balance of payment which record all such transactions between the residents of a country and the rest of the world which cause a change in the assets or liability of the country. Main items of capital account are direct investment, portfolio investment, loans, and banking capital transaction. So point number 1 is direct investment. Direct investment abroad means purchasing an assets in other country and at the same time acquiring control on it. Acquisition of a firm in one country by a firm in another country is an example of direct investment. Point number 2 is portfolio investment. Portfolio investment, on the other hand, is a form of investment under which a firm or a company of a country purchases shares of a foreign companies or buy bonds issued by foreign government. Under this form of investment, firm does not have control over the asset. Point number 3, loans. It includes commercial borrowing and external assistance. Commercial borrowing includes borrowing by a country from the international money market. This borrowing takes place at market rate of interest. On the other hand, external assistance refers to the concessional borrowing by a country. Point number 4 is banking capital transaction. This refers to transaction of external financial assets and liabilities of commercial banks and cooperative banks operating as dealers in foreign exchange. Next, difference between current account and capital account of balance of payment. Current account transaction brings a change in the current level of country's income. Capital transaction bring about a change in the capital stock of a country. Current account includes all items of flow nature and so it is a flow concept. Capital account, it includes all items expressing change, stock and hence it is a stock concept. Current account equal to visible trade plus invisible trade plus unilateral transfers plus income. Capital account equal to investment plus borrowings plus reserves. Next, autonomous and accommodating items of balance of payment. There are two types of items that take place in balance of payment account. These are autonomous items and accommodating items. So first is autonomous items. Autonomous items refer to those international economic transactions in the current account and capital account which take place due to some economic motive such as profit maximization. These transactions are independent of the state or balance of payment account. These items are also known as above-the-line items. For example, if a foreign company is making investment in India with the aim of earning profit, then such a transaction is independent of the country's balance of payment situation. Next is accommodating items. Accommodating items refer to the transactions that are undertaken to cover deficit or surplus in autonomous transaction. That is, such transactions are determined by net consequence of autonomous transactions. These items are also known as below-the-line items. For example, if there is a current account deficit in balance of payment, then this deficit is settled by capital inflow from abroad. The sources used to meet a deficit in balance of payment are foreign exchange reserves, borrowing from IMF or foreign monetary authorities. So students, the remaining topics we will continue in the next video. Thank you.